BP and Exxon out with earnings. The Alpine Dynamic Dividend Fund owns both of those stocks. Joining me is portfolio manager Sarah Hunt. Good to see you here.
Good to be here. Thank you.
I feel like you're a brave woman to own these oil company stocks. I mean, you're about dividends, so that's important. BP had quite a miss, though, on the earnings.
They did. And what I say at this particular point is you're not owning them for earnings right now, but it is unfortunate to see such a miss come out of BP specifically because there is more concern about BP than Exxon about their dividend just in the longer term. The CEO was quite vocal this morning in saying we don't mind letting our debt creep up. I mean, they're an A-rated credit, so they will let their debt creep up to pay that dividend. But I think the tricky thing right now is that oil prices are not being supportive of a higher cash flow situation that we can see going forward. So the first quarter also looks a little tough. So I think that there's a combination of fourth quarter and expectations of first quarter weighing on the stock right now.
And what about Exxon Mobil? Because Exxon actually did a little bit better. It could always be worse. So when you look at that stock, do you have similar concerns as you do with BP, or is it a different story on the balance sheet?
Exxon's balance sheet is so not problematic at this particular point that if they wanted to, if they could spend a lot more money than they're spending, and they're not spending it right now because they're also looking at the current price of oil and saying we can cut down expenditures. But I would say that Exxon I really don't worry about with their balance sheet, and they've got an enormous number of levers to pull on the cost side, and so I think that that's not particularly a worry at this point in time, even with lower oil prices, the way it is with some of the companies that aren't quite as big as Exxon.
And in terms of the dividend safety, are we talking about the payout will continue, or the payouts will continue but they might be cut back a little bit?
Well, I would say that for BP, again, they've been very vocal about the fact that they try to set a dividend that they can pay through the cycle, which means we expect sometimes for there to be low oil prices. So he was quite vocal this morning saying our debt to cap is only 21%. We could go up to 25. That wouldn't bother us at all. So they've got some room on there. But I think that if you saw $30 continue through the entire year, people would be a lot more concerned about everybody's dividend than they would if you start to see the oil price creep up again. I think by the back half of the year, you're going to see some higher prices because I think you're going to see U.S. production drop. So I think that's going to help the environment right now. But right now, the environment is really negative on oil prices.
You have, within the fund, a lot of different sectors represented. Is it time to add energy, or would you trim your energy holdings for this year?
I don't think this is a time to be trimming energy holdings. I think that you've got some pretty bad news in the oil price. We'll see if we go back and test 27. You've been bouncing around a fairly low level. There's always a possibility it's a commodity that in a very oversupplied situation, you see some price swings that are very surprising because storage is full, or you could see some pockets of very bad weakness. But I think that you're going to start to see the demand and supply kind of catch up to one another because it's also a demand problem as well. So if you start to see those match a little, you see a little supply come off from the U.S. I'm not expecting necessarily OPEC to do anything, but the U.S. comes down a little bit and you see higher demand a little bit. I think that then you're going to start to expect a balance, and the oil price always moves before the fundamentals catch up. So if that balance is expected, then you're going to start to see the oil price move higher.
Sarah, more broadly, what's your outlook for some of these dividend stocks this year? Let's face it, this is an awful start to the new year for stocks. So are the dividend yielding stocks still the safest way to go at this point?
Well, I think that you saw some weakness in the utilities and some of the dividend stocks at the back end of last year when people were expecting the Fed to raise rates, and then they did raise rates. And I think the expectation was if we're in an environment where rates are going up, then dividends are less attractive. But I think that what's happened with central banks in the interim has really put the focus back on dividends because bond yields are so low globally that a 4 or 5% dividend yield, I mean, Exxon's at 3.7%, that's a big difference than a 10-year that's sub 2% in the US. So I think that the dividend stocks are going to continue to get interest because it also looks like even if we got a tightening cycle, which now is a question in the US, it's going to be so slow that you're not going to get up to those rates that we're used to having on fixed income. So I think the dividends are going to stay in focus.
Sarah Hunt, great to see you again.
Thank you
so much. I'm Rhonda Schaffler for The Street.